Welcome to the Deep Dive, where we take a stack of information and extract the most important nuggets of knowledge for you. Today, we're cracking open the latest financial update from a company whose products, well, they're probably in your pantry right now, General Mills.
That's right. They just reported their fiscal 2026 first quarter results. And it's really much more than just a simple numbers report. It's a fascinating roadmap, really, for how a consumer giant is actively navigating what's a very dynamic market. They're focusing on everything from core product innovation all the way to leaning pretty heavily into artificial intelligence.
So our mission today is to unpack General Mills' overarching strategy for getting back to organic sales growth. We want to understand what they truly mean by remarkability, that's their term in practice, and highlight some surprising ways they're innovating, especially in areas you might not expect. We'll be drawing from their recent earnings call, their press release, to give you a clear, concise, and hopefully captivating look at what's really going on behind the scenes of this household name. So let's start with the big picture for General Mills this fiscal year. What's their number one goal, and what's their main strategy to get there?
Okay, so General Mills is laser-focused on restoring volume-driven organic sales growth.
Volume-driven, that's an important distinction, right? Not just price hikes.
Exactly. It means they're aiming to sell more products. Their core strategy for this is built around what they call the Remarkable Experience Framework.
Okay, remarkable experience framework. Sounds a bit like marketing speak, or is there real substance there?
Well, it might sound like it, but it signifies, I think, a deep understanding that today just having a product isn't enough. Not in this fragmented CPG market. Every single touch point, from how it's made to how it's advertised, needs to deeply resonate with consumers, almost at a micro-segment level, to cut through all the noise. So this means investing across 5 key dimensions: product, packaging, brand communication, omnichannel execution, and consumer value. That's how they plan to connect and drive sustainable, profitable growth.
Okay, so they have this ambitious goal, this framework. How did it actually play out in Q1? Let's unpack those numbers a bit.
Right, so organic net sales were down 3%. Adjusted operating profit is down 18%, and adjusted diluted EPS, that was down 20%.
Okay, those are declines.
They are, but, and this is key, these results were actually slightly ahead of their own expectation.
Okay. So better than they'd feared, maybe.
Exactly. It suggests that the declines were largely anticipated. They knew they were making these strategic investments in remarkability, plus there was impact from recent divestitures. The fact they beat their own internal targets, even slightly, is a positive signal. It suggests the plans might be starting to stabilize things, even in a tough market. Some competitors are missing even adjusted forecasts.
That's a fair point. And the overall sales number.
Total net sales for the quarter were $4.5 billion. That's down 7% overall. But there was a significant 4-point headwind just from divestitures and acquisitions.
So they're trimming some fat while investing in growth. Makes sense?
Precisely. Strategically pruning underperforming assets while reinvesting for the future.
Okay, let's dive into this remarkability concept with some, concrete examples. North America retail, that's their biggest piece, right? What progress are they seeing there?
Yeah, NAR is huge for them. And they're showing some genuinely encouraging signs there.
Yeah.
Get this. They held or grew pound share in 8 of their top 10 U.S. categories. That builds on momentum from last year.
8 out of 10 is pretty solid.
It is. And maybe even more significantly, for the first time in 3 years, they grew household penetration for their overall U.S. portfolio.
Wow, first time in 3 years. Bringing more households in. What do you think is the most critical factor driving that shift? And is it sustainable?
That's a really good question. I think it boils down to their consistent, integrated execution across all 5 dimensions of that framework we talked about. It's not just one silver bullet. When you've got strong innovation, smarter packaging, compelling ads, and better presence in stores and online, it creates a kind of flywheel effect.
Makes sense.
As for sustaining it, that'll depend on how well they keep adapting all those pieces to changing consumer tastes, economic pressures, all of that. But they seem geared up for it.
Can you give us a few specific examples? How are they executing across those 5 dimensions? It sounds complex.
Sure, let's break it down. First, product. Their Q1 innovation lineup was a real success. Things like the new Cheerios protein, Progresso Pitmaster soups, and Mott's fruit-filled bars. These apparently exceeded their expectations for customer acceptance and, crucially, distribution, getting onto shelves.
So these aren't just minor tweaks then?
No, they seem targeted, hitting specific needs like convenience, health, maybe a bit of indulgence.
Okay, product. What about packaging?
On packaging, they leverage what they call price pack architecture. Sounds fancy, but it just means offering new sizes and formats. This helped drive high single-digit pound growth in salty snacks, like their Gardettos or Chex Mix, and low single-digit growth in fruit snacks.
So different sizes for different budgets or occasions.
Exactly. Maybe a bigger family size or a smaller, more affordable single-serve option, making sure their products fit different shopping baskets. They talked about addressing price cliffs and gaps, basically strategic price adjustments to stay competitive and accessible across different price points, filling in gaps where maybe they were losing out.
Smart move, meeting consumers where they are financially too. How about brand communication? Getting the message out.
Yeah, they're making real strides here, especially with social-first media campaigns. Think Cheerios, Pillsbury. A standout example they mentioned was Cinnamon Toast Crunch. Get this, a 500% increase in social engagement for its Must in the Dust campaign.
Wow, 500%. That's huge for social engagement. What was the secret sauce there? What can other brands learn from that?
Well, from what they described, it sounds like a great mix of nostalgia, humor, and a concept that was just really shareable. It clicked with their audience. It felt native to social media, not just a TV ad dumped online.
Right.
That's the lesson, I think. Don't just push ads, create conversations. Understand the platform.
Right.
And it worked. That campaign led to growth in pound sold, pound share, and dollar share for Cinnamon Toast Crunch. So social buzz turned into actual sales.
That's the proof point. Okay, what about the last two dimensions? Omni-channel execution and value.
Right. For omnichannel, they highlighted a fully integrated free snacks for every backpack event for back to school. Hit online, in-store, drove value, got retailers engaged. And for value, as we touched on, those strategic price investments continue to cross about two-thirds of their NAR portfolio. They expect to wrap that up in Q2.
It really does sound holistic, connecting with consumers looking for value, but also those classic brands they love wherever they shop.
Absolutely. It's about the right product, right price, right place, right message, all working together.
Okay, let's pivot a bit. Beyond the usual pantry stuff, here's where it gets really interesting, I think. Their North America pet business. That's become a major growth engine, hasn't it?
Oh, absolutely. This is a fascinating area. General Mills is really accelerating into the faster-growing parts of the pet category, especially fresh feeding.
Fresh pet food, like in the fridge. Yeah.
Exactly. Just this week, Blue Buffalo's Love Made Fresh line, that's refrigerated fresh pet food, started shipping nationally. They're aiming for roughly 5,000 coolers in stores by the end of Q2. It's a very strategic move, tapping right into that huge humanization of pets trend.
You really see that everywhere, don't you? People treating pets like furry children. I know friends who cook special meals for their dogs. Is this trend moving even faster than they expected?
It seems like it. I mean, they've been watching it, obviously. The Blue Buffalo acquisition years ago was key to getting them into this premium space. I'd say they're strategically positioned, but yeah, the pace of growth in premium and fresh pet food has been remarkable. Rolling out Love Made Fresh nationally, this quickly shows real confidence in the demand. But you're right, it's a much more competitive space than, say, Dry Kibble. Lots of smaller, agile brands.
And they're not just stopping with Blue Buffalo, right? They've made other moves.
Correct. They launched Edgar & Cooper. That's a super premium European dog food brand here in the U.S. earlier this summer. It's exclusive with PetSmart for now. And then there's the recent acquisition of Whitebridge Pet Brands that brought them Tiki Cat.
Tiki Cat, I think I've seen that.
Yeah, it's already driving double-digit retail sales growth. They highlighted innovation there too, like Tiki Cat Solutions, very specialized products for specific cat health needs. Again, humanization, right? Treating pet health seriously.
Definitely. But it's not all smooth sailing in pet. You mentioned a challenge.
Right. That's an important point.
Yeah.
While things like Tiki Cat and the fresh food are booming, their Wilderness subline for dogs, which is more high-protein, meat-rich kibble, is facing some challenges.
What kind of hurdles, and what does improving its remarkability mean for Wilderness?
Well, it's facing intense competition. That high-protein segment is crowded with established players and lots of new brands popping up. So improving its remarkability means going back to that 5-dimension checklist for Wilderness specifically. Does the product formula need a refresh? Is the packaging communicating the benefits effectively? Is the brand messaging cutting through? Is it getting the right support in retail at the right price point?
So basically applying the same framework to turn that specific subline around.
Exactly. It's a continuous process of adaptation, especially in such a dynamic category like pet food.
It's just fascinating seeing a company known for Cheerios making such big plays in fresh dog food. What about their food service segment? The restaurants, schools, etc.
In food service, their focus is mainly on leading in breakfast think nutrition and expanding their frozen baked goods offerings. They actually saw their cereal market share increase by a full point in Q1, mostly driven by strong growth in K-12 schools.
Schools. That brings up something interesting you mentioned. Their commitment on colors.
Yes, a notable detail, their commitment to removing certified colors from their products by 2026. That's actually ahead of the USDA regulations. It reinforces what they call their regulation-ready portfolio.
Okay, being ahead of regulation is smart, but is there a bigger strategic advantage? Reputation, consumer preference.
Oh, absolutely, a bigger play. It's a powerful consumer signal. Think about it. Schools, parents, even many adults are looking for cleaner labels, more natural ingredients. By removing certified colors proactively, General Mills isn't just getting regulation ready, they're getting consumer preference ready.
Good point.
It boosts their brand reputation for health and wellness. That could be a real differentiator in winning over cautious school districts or health-conscious consumers. It might help secure long-term contracts beyond just meeting the minimum rules.
Makes sense. Now, General Mills is obviously global. How did the international businesses do?
International actually delivered pretty good growth. Organic net sales were up 4%. Haagen-Dazs retail sales outside of their shops were up double digits. They had a strong relaunch in China that helped drive high single-digit growth overall for the brand there.
Haagen-Dazs still has that premium appeal globally.
It does. Nature Valley also saw high single-digit retail sales growth, especially strong in France, apparently, where they've built up brand awareness and distribution, expanding their #1 share in snack bars there. Old El Paso, though, which is a huge global leader in Mexican food, faced increased competition. They have plans to invest more in brand building and innovation there, trying to reach new households, get current users to eat it more often.
Interesting mix internationally. Strong performance for indulgent ice cream and healthier snacks, but more pressure on meal kits like Old El Paso. What does that tell us about global markets?
It really underscores that even for massive global brands, local market dynamics are absolutely critical. Haagen-Dazs hits that premium indulgence spot, growing well in places like China where disposable income is rising. Nature Valley taps into a pretty universal demand for convenient, healthier snacks. Their success in France shows targeted marketing works. But Old El Paso, it's in a category where local tastes for Mexican food vary a lot, and competition from both big players and authentic local options is fierce.
Right.
So their challenge is staying relevant and distinct in a category that demands a lot of local nuance, in flavors, meal occasions, everything. Okay, so they're making all these big investments for marketability, innovation, international brand building. That costs money. How are they funding it on the operational side? That's the critical question, isn't it? They're driving efficiency in two main ways to pay for all this. First, through their ongoing Holistic Margin Management Program, HMM. That's their company-wide effort to find efficiencies, cut costs everywhere. Yeah.
They
expect HMM to deliver another 5% savings in cost of goods sold this fiscal year, fiscal 2026.
5% is significant.
It is. And interestingly, this is being partially enabled by increased use of digital and AI tools, specifically in their supply chain.
AI in the supply chain. That sounds really interesting. Tell us more about that global transformation initiative they mentioned. How are they actually using AI?
Yeah, this is a big one. And it shows how even, traditional CPG companies are seriously leveraging advanced tech now. They're specifically using advancements in machine learning for demand forecasting, predicting how much product they'll need, where, and when.
Okay, demand forecasting. Is it working?
Apparently, yes. General Mills said they actually started from a strong position in forecast accuracy, kind of in line with the best companies. But by shifting more of their business to what they call no-touch demand forecasting, meaning the AI does it without manual human intervention, they've achieved greater than 50% time savings for their brand teams.
50% time savings. Wow.
Yeah, and they're aiming for 75% over time. This frees up those human teams to focus on higher value stuff like demand generation and strategy, not just number crunching.
Makes sense.
And maybe even more importantly, they said it's resulted in their highest operational demand forecast accuracy ever, on record.
Higher accuracy and less human time spent.
Exactly, which directly translates to reducing waste from overstocking or spoilage, optimizing inventory levels, and improving customer service because the right products are more likely to be in the right place. It's a powerful combination.
That really is a powerful application of AI, not just flashy, but driving real bottom-line benefits. Okay, so it sounds like they're making some smart, strategic plays for the long haul. What's the outlook for the rest of fiscal 2026?
They reaffirmed their full-year guidance. They expect organic net sales to land somewhere between down 1% and up 1%, so roughly flat for the year overall. Adjusted operating profit and adjusted diluted EPS are both projected to be down 10% to 15% in constant currency.
Okay, so profit's still taking a hit this year.
Yes, but that's planned. They anticipate the main pressure from these growth investments and the impact of divestitures will largely hit the first half of the year, which we're in now. They expect improved volume trends as the year progresses, plus they have a 53rd week in their fiscal calendar this year, which helps. Those factors should drive more positive results in the second half.
So absorb the pain now for gains later.
That seems to be the strategy. They also expect strong cash flow, projecting free cash flow conversion of at least 95% of adjusted after-tax earnings.
Right. So despite the profit dips, it really is about that strategic investment in the long game. Short-term pain for hopefully long-term gain in market relevance and profit. And for anyone who wants to dive even deeper, they mentioned they're hosting an investor day in Minneapolis on October 14th. It'll be webcast too.
Yep, that should provide a lot more detail on the long-term strategy.
So there you have it. General Mills clearly not resting on its laurels. They're strategically investing in this remarkability from the product itself, its packaging, the advertising, how it reaches you online and in stores, every touch point.
And they're not afraid to innovate in totally new areas like fresh pet food. Plus, they're leveraging cutting-edge tools like AI behind the scenes to boost efficiency in some really surprising, impactful ways.
This deep dive really reveals a company working hard to adapt, adapting to changing demands for value, convenience, health, while also embracing technology for operational excellence.
It's a compelling look, I think, at how a household name is trying to future-proof its business in what is a fiercely competitive landscape.
Which brings up an important question for you, our listener. If a traditional CPG giant like General Mills is seeing such significant gains from using AI in things like demand forecasting, reducing waste, freeing up their people, what does that signal for the future of other large consumer brands? Could this quieter technological revolution happening behind the scenes actually be a more significant indicator of long-term success and competitive edge than any splashy new product launch? Something to perhaps mull over next time you're enjoying a bowl of cereal, or maybe considering a fresh meal for your furry friend.